Hi everyone, I hope you're all doing wonderful today. I am the Portfolio Panda. Daddy, get some popcorn and a drink of water for this one because it's going to be a long one. Today I'm going to be tearing apart Australian Super. Australian Super is the largest superannuation fund in Australia. They are an industry superannuation fund run only to profit members. Australian Super has a MySuper authority, meaning it can accept default contributions from an employer on behalf of employees who have not nominated a superannuation fund. Does larger mean better? When you start work, if you don't nominate a preferred super account or your employer can't establish if you have a stapled super account, then you will be signed up to the MySuper account of the provider preferred by your employer. Like all super funds, the objectives are to provide retirement income for their members. Couple of disclaimers. They offer a range of premixed options depending on your risk appetite, remembering that the words used are determining asset allocation, not a guarantee of growth. Performance is taken as at the 30th of June 2022. Balanced. Okay, let's start with performance on this one because that's usually the most interesting part. Historical performance. We can see over the past 12 months it has returned minus 2.73%, and you're probably wondering what the hell, why am I forced to give up part of my pay packet just so these idiots can go and lose it on my behalf? You're absolutely correct, but also we can look at the longer term performance to get an idea of what it averages out to over time. The two letters next to the percentage marks on these returns indicate per annum, which means how much is returned per year when averaged out over 3, 5 or 10 years. So we can see that over the period of 10 years the balanced option has returned, on average 9.32% per year. Asset allocation: Australian shares 21%, international shares 31.5%, private equity 5.5%, infrastructure 14.75%, property 6.75%, credit 7%, fixed interest 9%, cash 4.5%, high growth. I'm going to start off here with the asset allocation to show you the difference between the high growth option and the balanced. As you can see before, the balanced option gives you a total of 58% of shares when you add the domestic, international and private equity together. So looking at the high growth option, we have a total of 73.75% invested in shares, which is only a 15.75% difference between the two. Given the suggestive name of high growth versus the timid sounding balance, you would expect the allocation gap to be much higher. Hey, is that just me that thinks that? Anyway, Australian shares 27.25%, international shares 40.75%, private equity 5.75%, infrastructure 12.75%, property 6.5%, credit 1%, fixed interest 2%, cash 4%. Performance: we can see that over the 12 months it has lost 3.93%, more of a loss than the balanced option, which given the higher risk nature of the option is to be expected. Looking over at the 10-year, we can see an average return of 10.28% per annum. Socially aware: exclusions are applied to the Australian shares, international shares and fixed interest asset classes based on ESG screens. The option also invests in a range of other asset classes that are not screened. Asset classes that are not screened include private equity, unlisted and listed infrastructure, unlisted and listed property, credit, cash and other assets. The screens are not applied to non-corporate, for example government securities, which represented 68% of the fixed interest asset classes at the 28th of February 2023. The asset allocation is similar to balanced. Australian shares 21%, international shares 31.5%, private equity 5.5%, infrastructure 14.75%, property 6.75%, credit 7%, fixed interest 9%, cash 4.5%. Performance: it's expected that if you are choosing a socially responsible option, that returns may not be as good as a fund that is open to investing in highly profitable but unethical options, and as we can see, it rings true in this instance. We can see a loss of 3.3% in the past 12 months at only 8.62% return annualized over the past 10 years. So what's excluded? Australian Super's ESG and stewardship program applies to the socially aware option. In addition, the socially aware option applies screening to the Australian shares, international shares and fixed interest asset classes, which covers around 61.5% of the fund and which aims to remove the shares or fixed interest securities of companies that directly own thermal coal, oil or gas reserves, manufacture tobacco products, cluster munitions or land mines, have single gender boards for S&P and ASX 200 companies, have received the highest severity rating on a labour rights, human rights, environmental or governance controversy from the relevant ESG research provider. In this case they are part of the Australian Council of Superannuation Investors for Research, directly own uranium reserves in the case of the Australian shares and international shares asset classes. Reserves, in this context, are thermal coal, oil, gas or uranium that can be extracted from known fields at an economical cost. They can still invest in companies that lend to or have managed funds with shareholdings in the excluded companies, buy, sell or process products from the excluded companies such as petrol refineries and distributors, provide products and services to the excluded companies such as security, catering and office suppliers. I will crack this particular option open and have a better look at it later in the video. Index diversified, invests in a range of assets using indexing strategies. Australian shares 28%, international shares 42%, fixed interest 25%, cash 5%, performance arguably the worst performing option. Over the past 12 months, it managed to lose 5.7% and only return on average 7.37% for the 10-year statistic. However, it is worth noting that this big loss in the past 12 months will negatively impact all the previous gains as they are averaged. Conservative balanced includes a higher allocation to fixed interest and cash than the balanced option. Australian shares 14.5%, international shares 22%, private equity 4.5%, infrastructure 11.8%, property 7%, credit 7.75%, fixed interest 24.5%, cash 7.5%. Strangely, this apparent conservative option has been hit harder in the past 12 months at negative 2.9%. It has returned 7.47% on average over the past 10 years. Stable, an emphasis on fixed interest and cash with a higher focus on stability than growth. Australian shares 8%, international shares 12%, private equity 1.5%, infrastructure 12%, property 6%, credit 8.25%, fixed interest 31.25%, cash 20.5%. Performance has been predictably more stable than the other options, with the 12-month losses at 2.42% and returning 5.67% annually over the past 10 years. DIY Mix lets you choose your own asset allocation between Australian shares, international shares, diversified fixed interest and cash within the products available through Australian Super. Member Direct. You make your own strategy by investing in your choice of shares in the S&P ASX 300 index, exchange-traded funds, listed investment companies and term deposits. Fees, gross. Administration fees and costs for your super account. Flat administration fees $1 a week, and your asset-based administration fees 0.10% per annum of your account balance up to a maximum of $350 yearly. Investment fees and costs. Investment fees and costs are charged to cover the costs of managing your investments, including external investment management fees and performance fees, which basically means the fund managers and investment team's salaries and their bonuses. For the pre-mixed and DIY mix investment options, investment fees and costs vary between 0.06% to 0.52% per annum of the amount invested depending on the investment option. They are deducted from investment returns. Transaction costs. Transaction costs are incurred when buying and selling underlying investments for the pre-mixed and DIY mix investment options. Transaction costs vary between 0% to 0.20% per annum of the amount invested depending on the investment option. They are deducted from investment returns and reflected in the daily crediting rate. When trading shares, ETFs and listed investment companies for the member direct investment option, brokerage fees will apply on each trade. Brokerage fees are at 0.1% of all purchases over $13,001. Under this is a fee of $13. Advice fees. For over-the-phone advice about simple matters, a fee of $295 is payable from your Australian Super account. If you receive personal financial advice that is not provided through the over-the-phone advice service, the fee you pay will depend on the nature and complexity of the advice. The Panda Test. So we will focus on the socially aware option for the Panda Test today because that is the fund with the most opportunity to mislead consumers. All this information is current as of 31st of December 2022. First red flag for me. They have about 15.88% of the fund, or $655,843,000 held with external fund managers, some of them including BlackRock and Hamilton Lane. It's anyone's guess where this money is being invested, so that's an automatic fail. Now we get to the juicy part. What kind of companies is this fund invested in? They might try to hide by claiming that, oh no, you needn't worry. We only allocate a very small proportion of the money to these evil companies, so it's okay. Well, let's have a look then, shall we? L'Oreal claims to have stopped testing on animals since 1989, but that doesn't mean they can't just pay other people to do it for them. L'Oreal still sells cosmetics in China that are required by law to be tested on animals. The CCIC's Leaping Bunny program administers a cruelty-free standard for companies producing cruelty-free cosmetic and personal care products. L'Oreal is not on their list. The fund holds $12,618,554, or 0.47% allocation in this company. CSL. The majority of plasma sourced by CSL comes from the US. Some vulnerable people can suffer harm from giving plasma. This is particularly relevant in a time of increasing unemployment and underemployment where people are looking for supplementary income. The fund holds $50,513,600, or 1.86% allocation in this company. Microsoft. They are accused of being connected to forced Uyghur labour in Xinjiang. Microsoft is reported as being supplied by 3 Chinese factories employing Uyghur and Xinjiang workers. There are also issues surrounding privacy and internet censorship worldwide. The fund holds $27,623,064 or 1.02% allocation in this company. Aristocrat Leisure Limited is an Australian gambling machine manufacturer making slot machines and software. They also own Plarium Global Limited, which you may know from a commonly advertised game raid Shadow Legends. What a coincidence that a mobile game is owned by a gambling company, isn't it? The fund holds $15,188,422 or 0.56% allocation in this company. The Lottery Corporation Limited, as you might guess, is a lottery company. Their brands include the Lot, with instant scratch-its, and the Powerball lottery ticket or Keno, which are regularly used at clubs and pubs. The fund holds $14,428,653 or 0.53% allocation in this company. I'm going to butcher the pronunciation here, so I apologise in advance. LyondellBasell Industries, among other petrochemical facilities at Berlading, France, are regularly criticised in the French media and by local authorities for their large-scale flaring activities generating giant smoke plumes with lengths reaching dozens of miles. The concomitant atmospheric pollution includes organic chemical compounds such as carcinogenic benzene, butadiene and toluene. Not only the nearby cities of Vitrolles, Rognac and Marignane suffer from this pollution, but it is also held responsible for the deterioration of the air quality in the city centre of Marseille. At an approximate distance of 20 kilometres from LyondellBasell's facility, the fund holds $14,237,591 or 0.53% allocation in this company. Diageo is a British multinational alcoholic beverage company. It is a major distributor of Scotch whisky and other spirits. Distilleries owned by Diageo produce 40% of all Scotch whisky, with its leading brands including Johnnie Walker, Guinness, Smirnoff, Baileys, Captain Morgan Rum, Tanqueray and Gordon's Gin. The fund holds $12,149,743 or 0.45% allocation in this company. At this stage, Procter & Gamble is not cruelty-free. They may test on animals, either themselves, through their suppliers, or through a third party. A search in the Leaping Bunny program shows that they are not listed. The fund holds $12,121,692 or 0.45% allocation in this company. Northrop Grumman currently leads the development of the B-21 Raider, a long-range, stealth strategic bomber that can drop conventional and nuclear weapons. It was also the sole bidder on the Air Force's Ground-Based Strategic Deterrent Program, which aims to develop and build a new intercontinental ballistic missile. The fund holds $11,952,944 or 0.44% allocation in this company. Endeavour Group Limited used to be a part of Woolworths until they split, presumably so Woolworths could clean up their image and distance themselves from the hotels and gambling and alcohol business which Endeavour Group is involved in. The fund holds $11,842,237 or 0.44% allocation in this company. Abbott Laboratories contract tests out to Huntington Life Sciences. Huntington Life Sciences is the third largest contract research organisation in the world and the largest animal testing facility in all of Europe. Firms hire CROs to conduct animal toxicity tests for agrochemicals, petrochemicals, household products, pharmaceutical drugs and toxins. HLS has a long history of gross animal welfare violations. The fund holds $10,934,290 or 0.4% allocation in this company. Northern Star Resources Limited is an Australian gold mining company with operations in Western Australia, Northern Territory and Alaska. The fund holds $10,758,252 or 0.4% allocation in this company. I'm choosing to stop here under the $10 million mark for the individual stocks because while it's a large amount of money, I also want to stop before I bore you all too much. The other major thing that people may have issue with is who the fund is lending money to in the form of bonds. If you're unsure what bonds are, I'll leave a link to my video on what are bonds so you can have a look after finishing this video. The fund holds government debt for both the Chinese government and the Israeli government, though both of these are relatively small at under $1 million each. With a name like Socially Aware, you would assume that there wouldn't be anything in the fund that could fall under the category of distasteful to the socially conscious investor, but scratch the surface just a little and you can see the truth. They can claim all they like that it only makes up a small portion of the fund, but there is still easily over 100 million of your money being pumped into companies in a misleading way. If you want to invest your super into a fund that does not take part in these greenwashing practices, you unfortunately will need to do a lot of reading. Or just watch my videos, of course. As usual, let me know any questions in the comments below and make sure to share this with your least financially savvy friend, then tell me if I did okay at explaining the topic. Your most valuable asset is your time. Thank you for sharing yours with me. Until next time.